our good friend Jimmy Brown sent me a news story. So this is the economic report sponsored by Jimmy Brown inside of the Center Guard Plumbing mailbag. He sent me a Fortune article. The economy is just getting stronger, not weaker. And we in the economics profession need to look ourselves in the mirror, top analyst says. Long story short, one of Wall Street's most closely watched voices delivered a blunt message to peers and policymakers. The U.S. economy is not faltering. It is accelerating. Torsten Slok, chief economist at Apollo Global Management, which is one of the largest hedge funds in the world, okay, run by a very, very smart guy who married a very, very beautiful, intelligent woman, Jamie Gertz, who I went to high school with, who grew up in Glenview, said forecasts of imminent slowdown have been repeatedly wrong, and the economics profession should start grappling with its record of misjudgments. Okay, so that's according to Torsten Slok, the chief economist at Apollo. In the meantime, we're sending $20 billion to Argentina to prop up their economy, while our farmers are losing markets to the Chinese, to the Argentinians, because the Chinese aren't buying their soybeans anymore. And I just kept seeing story after story of farmers out there who their crops are going down in value because of all these tariffs. And then breaking news here, searches for second job on the internet reached an all-time high, surpassing the 2008 financial crisis and COVID pandemic levels. In addition to that, layoffs are running at historical highs. U.S. job cuts announced fell 26% in September, making this just the third month this year with year-over-year decline in cuts. In third quarter, planned layoffs rose 16%, the highest third quarter since the pandemic in 2020. Year-to-date, U.S. employers have announced 946,000 job cuts, the highest total since 2020. This is also the fifth highest reading over the last 36 years of Challenger, Gray, and Christmas data, who is a huge job following company.
But don't we run across this all the time, especially at end of quarters and coming up towards the end of the year, and they're not making their numbers, and they got to make their investors happy.
Hold on. It gets better. If you have one or two variables, maybe here's some more. So these are the things that I look at. Unemployment, okay? Number one, unemployment. Number two, I look at oil prices. Okay, why oil prices? If oil prices are dropping, that means that the world demand for oil is dropping, which means the economy is slowing down.
Or the surplus is going up. You're drilling more, right?
Or the surplus.
But when oil prices go down, then I know that my prices go down because shipping goes down.
Well, and that's another thing. That's what I've got coming up here. Container shipping costs are plunging again. Okay, the spot rate for a 40-foot container from Shanghai to Rotterdam, which is Europe, fell to its lowest level since December 23. Okay, so stuff's not going from China to Europe as much as it did in the past. Shipping costs, weaker shipping costs from Shanghai, okay, to Los Angeles dropped to its lowest level since December 2023. So now when you start thinking of all this, weaker global demand, price wars, and exceeding shipping capacity have driven the decline. Meanwhile, U.S. import volumes are expected to continue to decline towards the end of the year, with January 2026 projected to be 19% lower.
And how are our exports doing? Do you know?
The exports aren't great because of all the tariffs, and people in foreign countries are saying, have a nice day. Thanks for that. We're not buying your goods. Ask the farmers how that's working out for them. Okay, so when you start looking at all of these variables, the costs coming back, right, because of the shipping, fuel's going down, which is great for interest rates, okay, because a slowing economy is great for interest rates. It's great for you. Well, you don't bring any junk in from over there. You get all your junk, around here. But the stuff that you bring in overseas, it's going to cost less to bring it in. Here's the other thing. The dock workers in L.A. are not going to be working as many hours. The freight companies that take those containers are not going to be working that many hours. The railroads that haul those freights and those boxes are not going to be working as many hours. And there's going to be less containers going to warehouses here and throughout the United States that are going to need to be unloaded from those trains and put into warehouses, and that's going to trickle down through the whole economy. I'm just giving you variables.